Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section H, and this is an application topic. Calculate the interest expense attributable to notes payable reported in the financial statements. And just letting you know, this is half of a blueprint topic where it talks about notes payable and bonds payable. I'm going to be talking about bonds payable in the next video. So again, we're going over interest expense for notes payable in this video, and we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training where we teach the key ingredients to passing the CPA exam. Again, it's 1 hour, it is free, and we will show you how to be effective and efficient with your studying so you don't waste months or even years of your time. And if you like that, you'll probably want to learn more. And if you become a pro member of SuperfastCPA, you'll get access to the pro course, which is where we go super in depth and teach you how to do the whole process step by step. And also, if you become a SuperfastCPA Pro member, you get access to the full 10-question versions of these 5-question YouTube videos. So if you like this 5-question video, again, if you become a Pro member, you get access to the full 10-question video, or sometimes more than that, so that Pro members can get extra practice and extra understanding of these topics. So make sure you check out the webinar and make sure you check out becoming a Pro member. And with all that said, now let's dive into the questions. All right, here we are at question 1. And one thing we always like to point out is it's a really good habit, a really good strategy to always read the last part of the question first. It doesn't always work, but it's a really good habit to be in because on test day, you're going to be seeing questions from all kinds of different topics. And if you read that last part frequently, it will give you context for what the question is even about, so that as you're reading through, you're already thinking about, okay, what do I need to be looking for? Again, it gives you that extra context so you can answer questions more quickly. So we read the last part first, and then we go to the top. What portion of the second payment due on June 30th, year 1, will be allocated to interest expense? Okay, let's go up to the top here. On January 1st, year 1, Ember Corp borrowed $120,000, signing a 3-year note payable with an annual interest rate of 8% compounded quarterly. The loan requires quarterly payments of $10,000 beginning on March 31st, year 1, which cover both interest and principal. So again, with that information, we have to figure out what portion of the second payment, which is on June 30th, will be allocated to interest expense. Now, this is a fairly simple thing that a lot of people know how to do. They know how to calculate interest and principal and things like that. So pause the video if you know how to do this and come back when you're ready. If you don't really know, or if it's been a while, or again, if you're kind of getting into this for the first time, that's okay. We're using these questions to learn how to do the material. So we're going to go to the answer and learn how to do this, and that will give us context and understanding for the rest of the video as well. So let's go ahead and go to the answer if you haven't already paused the video to try it on your own. All right, the answer is B, $2,248. So that is the portion of the payment in June that's going to be interest. So let's walk through this. To find the interest portion of the second payment on June 30th, we calculate the interest expense on the remaining principal after the first payment. So we have to calculate the first payment to be able to know how much the interest expense is going to be for the second payment. So for the first payment, for the first quarter, you take the original carrying amount, the original principal of $120,000, you multiply it by 8%, which is the interest expense. But remember, these are quarterly payments. So you have to divide that interest expense by 4 to give you kind of a quarterly interest expense. So really it's $120,000 multiplied by 2% gives you $2,400 of interest for the first payment. Now, each payment is always going to be $10,000, but the principal and interest portions of that $10,000 will vary as time goes on. So the first payment is $10,000. You subtract the interest expense of $2,400, and that gives you $7,600 of principal for the first payment. So you take that $7,600 and reduce the carrying amount of the loan by that $7,600 of principal, giving you $112,400 of principal after that. Like, that's the carrying amount at that point. Now you can calculate the interest expense for the second payment because you know the correct carrying amount going into the second payment. So $112,400 multiplied by, again, it's technically 2% because it's 8% divided by 4 because these are quarterly payments. $112,400 multiplied by 2% is $2,248. That is going to be the interest expense portion of the second payment in June. So again, not too difficult. You kind of just have to walk through it and remember to always apply the principal amount, not the full payment, because interest is not going to reduce the principal. It's not going to reduce the face value of the loan. Interest is separate. So always remember to do that, and that will help you be able to calculate the interest as time goes on. With that was the first question. Now let's go to the next question to learn about another aspect of interest for notes payable. All right, here we are at question 2. What amount of accrued interest receivable should Silver include on its December 31st year 1 balance sheet? Okay, we're talking about accrued interest at this point. On October 1st, year 1, Silver Bank issued a $150,000 10-year loan to Ocean Corp. The loan carries an annual interest rate of 9%, and interest is compounded quarterly. Ocean Corp received $145,000 because Silver Bank charged Ocean Corp a $5,000 non-refundable loan origination fee. Quarterly interest payments are due beginning January 1st, year 2. Assuming Silver Bank recognizes interest income quarterly, what amount of accrued interest receivable should Silver include on its December 31st, year 1 balance sheet? So we have to figure out how much interest is accruing between quarters and maybe between year end for this loan. But we have a few different factors here. We have the initial amount of $150,000. We have the amount they actually received, $145,000. We have the loan origination fee, a whole bunch of different things like that. If you have any idea how to do this, that's great. Pause the video and do it yourself. If you don't really understand what's even going on here, again, that's okay. We are using these questions to learn how to do this. So if you want to try yourself, pause the video. If not, let's go ahead and look at the answer together. All right, here we are. The answer is B, $3,375 is going to be the interest receivable that they have at the end of the year. So let's walk through this. To determine the amount of accrued interest receivable, we need to calculate the interest earned from October 1st to December 31st, year 1, which is a 3-month period on the original loan amount of $150,000. So to do that, this is something you'll have to do whether it's month by month, quarter by quarter, semi-annually. You have to take the interest rate that's given, which is usually an annual rate, and divide it by however many. Again, in this case, it's quarterly, so we divide it by 4. If it was monthly, you would divide it by 12. That gives you the quarterly interest rate. So 2.25% per quarter is the actual interest rate for these calculations. So we go here, calculate the interest for the 3-month period, 1 quarter, $150,000 multiplied by 2.25%. That gives you $3,375. So that's the easy answer right there. But you could have gotten confused by the loan origination fees and maybe even by, the fact that it was quarterly. So let's talk about the origination fees. The $5,000 origination fee does not impact the principal used to calculate interest. So you're still calculating interest receivable based off of the face value. So even though there was $5,000 taken out, they only received $145,000. But to calculate the interest receivable, you calculate it with the face value. So $150,000 multiplied by that 2.25%. So if you see multiple interest rates, when it comes to calculating the accrued interest receivable portion, it will be based on the original principal amount and its effective interest rate. And that might come up in some questions that you see in your review course or on the exam. So with that is how you calculate the accrued interest receivable in this case. You really just take the face value, multiply it by that quarterly interest rate, and that gives you the interest for that quarter. Now let's go to the next question. All right, here we are at question 3. What is the carrying amount of the note on January 1st, year 1, and what is the interest expense Echo Corp should recognize at the end of year 1? Okay, let's go up to the top here. It's kind of a double question. On January 1st, year 1, Echo Corp received a $100,000 non-interest bearing note from a customer due in 3 years. The market interest rate for similar notes is 6% per year compounded annually. The present value factor for a single sum of 6% for 3 years is 0.8396. So with that information, again, what is the carrying amount of the note on January 1st when they get the note, and what is the interest expense that they have to recognize at the end of the year? Remember, this is an annual thing. We're not doing quarterly anymore. So it's not too difficult if you kind of have an idea of what to do. If you're confused by the present value factor or things like that, that's okay. Again, we're going to look at the answer, but I think you should probably give this a try. Try to see if you can get the right answer on your own. And when you're ready, come back. We will look at it together. All right, here we are. The answer is B. The carrying amount is going to be $83,960, and the interest expense is going to be $5,038. So this seems a little bit involved, but it's not too bad. So we're going to talk about this, and we're especially going to talk about non-interest bearing notes and how interest works with a non-interest bearing note. So let's talk about this. So to calculate the carrying amount of a non-interest bearing note, we actually have to take the face value, multiply it by the present value factor that we were given. And so that's $100,000 multiplied by 0.8396, and that gives us $83,960. So technically, even though there's no interest on this note and the face value is $100,000, the present value of it is $83,960, and we'll talk about that a little bit in just a second here. So that's the amount we're going to use to calculate interest. We calculate interest expense for year 1 using the market rate of 6%. So $83,960 multiplied by 6% is $5,037.60, or really $5,038. And it started at the beginning of the year. This is an annual interest rate. They're paying it annually, so we can just calculate the full amount. We don't have to worry about months or quarters in this case. So again, the carrying amount at the beginning of the year is that $83,960, which is the present value, and the interest expense is based off of that using the market rate, giving us $5,038. Now again, that might be a little bit confusing. You're like, this is a non-interest bearing note. Why are we calculating interest? So here's why you do it. For a non-interest bearing note, interest must still be recognized because the borrower repays an amount greater than the note's present value today. This difference represents imputed interest, reflecting the time value of money. Essentially, a dollar today is worth more than the same dollar in the future. So now because of that, the note is recorded at present value using the market interest rate to reflect its true economic value when issued. Although there's no stated interest, the interest expense is recorded each period because, based on this imputed interest, gradually increasing the carrying amount to reach the face value at maturity. This approach provides a more accurate financial picture and aligns with accounting standards. So this is something you have to do. If you have a non-interest bearing note, you do have to calculate imputed interest on it, and you do that based off of the present value and the market rate for that note or similar notes. So that's how you handle non-interest bearing notes. Now let's go to the next question. All right, here we are at question 4. What total amount of interest revenue should Lakeview Corp recognize over the life of the note? On January 1st, year 1, Lakeview Corp issued a 7-year note with a face amount of $200,000 and a stated interest rate of 5% compounded annually. The note requires annual payments of $34,517 beginning December 31st, year 1. Due to a discount applied at issuance, the note's present value is $150,000 based on a market interest rate of 8%. So again, with all that, we have to figure out what the interest revenue is that they're going to recognize over the course of the loan. Now, this is actually quite easy if you know what to do. If you don't know how to do it, that's okay. That's why we're going to go over this question. But if you have an idea, go ahead and try, pause the video, do it on your own, and when you're ready, come back. We will look at it together. All right, here we are. The answer is C. $91,619 is the interest revenue that is going to be generated over the course of the 7 years. So how do we know that? Let's go to the explanation. To determine the total interest revenue that Lakeview Corp should recognize over the life of the note, we calculate the difference between the total of all the payments and the present value of the note. So the total of the payments is that $34,517. They're going to be paying that annually, and you multiply that by 7 years, that gives you $241,619. That's going to be how much they're paying over the whole life of the loan. But we have to subtract the present value of the note to know how much of that is actually interest. So the total interest revenue is $241,619 less the $150,000 present value that we have, and that's $91,619. So even though the face value is $200,000, because of that discount applied at issuance, it actually has a present value of $150,000. So again, we have to compare that to the total amount that they're going to be paying over the course of the loan, and we know that $150,000 is the principal, and that $91,619 is the interest that's going to be the revenue over the course of the note. So that's another thing that you need to know how to do. Now let's go to the next question. All right, here we are at question 5. What is the total interest expense for Maple Corp in year 2? So let's go up to the top here. On January 1st, year 2, Maple Corp had 3 outstanding short-term loans, each with different principal amounts and maturity dates. Each loan has an annual interest rate of 6%. Maple Corp gave the following details for each loan below. So loan A has a $90,000 principal. It was issued on December 31st of year 1, and it matures on October 31st of year 2. Loan B is a $50,000 loan issued on January 1st, year 2, maturing April 30th, year 2. And loan C has $70,000 of principal, and it was issued on December 1st of year 1, and it matures on June 30th of year 2. So with all that information, we have to calculate the total interest expense from these loans for year 2. Try this on your own, pause the video, come back when you're ready, and we'll look at it together. All right, here we are. The answer is C. $7,600 is the amount of interest expense that's going to be from all these loans. So let's walk through this. Again, it's not too difficult once you kind of think through it. To calculate the total interest expense for year 2, we calculate the interest expense for each loan individually based on the portion of the year it was outstanding, and then sum it up. So interest expense for loan A, it matures on October 31st, so it was outstanding for 10 months in year 2. And that's because from January all the way to the end of October, that's 10 months. So $90,000 multiplied by 6%, that would give us the annual rate, but it was only outstanding for 10 out of 12 months. So we multiply it by 10 divided by 12, and that gives us $4,500 of interest expense from loan A. Now the same thing for interest expense for loan B. It was only outstanding for 4 months because, beginning of January all the way till the end of April, that's 4 months. $50,000 multiplied by 6%, that would give us the annual rate. So to get the rate for just 4 out of 12 months, you multiply that by 4 out of 12, and that gives you $1,000. And then for interest expense for loan C, I wanted to kind of show you for this one that sometimes you do need to know how much interest is being paid in one year and how much interest is being paid in another year. So make sure you pay attention to that. So that's what this one is for. Interest expense for loan C, it matures June 30th of year 2, so that's 6 months of year 2, but the loan was originated on December 1st of year 1, meaning there was 1 month of interest accounted for in year 1. So if that ever came up in a question where you needed to account for interest in a previous year, this is the kind of thing you would have to do. You'd have to take into account the whole life of the loan, which in this case is 7 months. So $70,000 multiplied by 6% multiplied by 7 out of 12 gives you $2,450 of interest over the course of those 7 months. But again, 1 month out of those 7 months was actually in year 1. So if you multiply $2,450 by 6 out of 7, or you could also do $2,450 divided by 7 multiplied by 6, that would give you $2,100 for year 2, and then the difference would be what was in year 1. Now, you may be thinking, did I really need to do that? To figure out for year 2, actually you could have just done 70,000 multiplied by 6% multiplied by 6 out of 12, and that would have given you the $2,100. But again, that one was kind of there to show you that sometimes you are going to have to figure out how much was in one year, how much was in another year, and you can kind of do that by dividing the whole interest expense that you calculate by however many months. So again, $2,450 divided by 7 would give you how much interest expense to take into account each month, and that could help you know how much was in year 1, how much was in year 2, and so on. But overall, you could have just done $70,000 multiplied by 6% multiplied by 6 out of 12, and that would have given you $2,100. And if we add all of that up together, $4,500 from loan A, $1,000 from loan B, and $2,100 from loan C, that gives us $7,600 of interest expense from these 3 loans. And they had different maturities and different things like that, but really not too difficult to calculate if you can count how many months they were active in the year that you're trying to deal with. So with all that, we learned a whole bunch of stuff about interest, interest income, interest expense, for notes payable. And before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics with SuperfastCPA is as you're going through the questions to learn the material, you will notice the things that keep popping up. You see 3 or 4 questions trying to teach you how to calculate interest for a non-interest bearing note. Or you'll see 3 or 4 questions trying to teach you how to calculate interest revenue based off the total amount of payments and the present value of the note, or whatever the case may be. You're going to see these things pop up. These are the equations, the topics that you notice throughout the questions. So you take a moment after you're studying and you write these down in your own words, kind of summarizing the most important things you learned from the questions that day. And as you're doing this each day, you're kind of building a repository of your own knowledge of the most important things in your own words, in your own thoughts. And by the time you get to the exam, you will have this fairly succinct list of pillar topics that you need to know for the exam, and you know what's most important. So with that, let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Again, this is kind of a summary of the most important things that we learned from this video. So remember, present value of calculations for notes. You calculate the present value of non-interest bearing or discounted notes using the market interest rate and the given present value factor to determine the note's initial carrying amount, and you can use that carrying amount to then calculate the interest. Even if it's a non-interest bearing note, you still have to calculate interest on it, and you use the present value factors and market rates to figure that out. Now, total interest revenue or expense recognition. Determine total interest revenue or expense over the life of a note by calculating the difference between the total payments and the present value of the note at issuance. So that's kind of a quick way to know the total interest that's going to be over the course of the loan. You're not going to be able to necessarily know exactly how much each interest payment is. You're going to kind of have to do the principal calculations and things like that to do that. But you can figure out the total interest by doing this. And then for partial year interest calculations, for loans with partial year terms or mid-year issuance, calculate interest expense by prorating the annual interest rate according to the number of months outstanding. And then finally, for handling loan origination fees, record notes with origination fees at the present value of cash received, not the face amount, and recognize the difference between interest earned and interest receivable as deferred interest income or expense over the note's term. And with that, we've gone over the pillar topics for this video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, sign up for that because we will teach you the key ingredients to passing the CPA exam in just 1 hour for free, and you'll probably like it and you'll want to learn more. So make sure you check out becoming a SuperfastCPA Pro member, and with that, you'll get access to our Pro course, where we go really in depth on the whole study process and teach you exactly how to study day to day, week to week. It's extremely helpful. And an additional thing, if you become a pro member, you again get access to these 10 question videos that are the full versions of these 5 question YouTube versions that I create. So if you like this and you like our other products, make sure you check out becoming a SuperfastCPA CPA Pro member, and you will get access to a lot of great resources. Now, if you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next